The past few videos, I've been showing you a lot of trades that I've been making, selling options, generating premium. But what I wanted to do in this particular video is show you guys two stocks that I'm looking to acquire shares out of and how I'm using put options to do that. And what we'll be talking through is the concept of fair value or intrinsic value, where we try to analyze a company to understand the fundamentals to determine a fair price to buy this particular stock at or buy this company at. And that's what we're going to do. We're going to use my proprietary indicator, which is absolutely free on TradingView. Link is down below. It's called the OGT Intrinsic Value Indicator. So if you like the sound of that, all I ask for is that you smash that like button and don't forget to subscribe. Now, the two companies in question is Meta, which I talk about a lot on the channel, and I trade options a lot on it, trading naked calls and naked puts on it through other challenges that I've done. But I am looking to acquire shares. I own no shares of Meta whatsoever, but I am looking to acquire at least 100 shares of this company. And the second one is Google as well. I just want to own Google, right? They've recently went through their stock split a couple of months ago, and it's at a more attractive price for me to go acquire 100 shares of this company. I do own about 4 or 5 shares of this company, as in just reinvesting the premiums that I've gained from other stocks I've traded, but I want to acquire 100 shares and add that to my actual portfolio. So before we go into what this indicator is, I want to explain very quickly the concept of intrinsic value. Now, this graph over here shows the left-hand side shows the share price, which over time stocks generally go up, and there we have the time. The black line is the share price, right? The share price or the company price goes up and down all over the place. And what happens then is over time, this red line, the intrinsic value of the company is what is the fair price of the company, will also change over time. And, if you buy a company or shares in the company at this level, we are currently overvalued. And if you buy it at this value, currently undervalued, which is why things like dollar cost averaging strategies tend to work well over the long term, because if you do it on growth or high great earning companies, over time your portfolio is going to go up. So when I am looking to get into Meta or Google, what I'm looking to do is select my strike prices where I'm underneath the red line. Now the key question is how do we calculate that red line that we can see on this graph? And there's multiple methods, and the method that I'll be using is the EPS, or the earnings per share valuation. And what it does, it measures the earnings and then adds a multiple layer on top of that. And again, I've got a dedicated video, which I'll link to below on the top right corner. And what we have here is you plug in a range of assumptions on what you think the EPS will be over the next 5 years. And again, I walk through in that video how I get to these numbers and what assumptions you can make. And then I also then talk about the return, and then what the multiple is going to be. Is it 10 times, 13 times, or 15 times? And again, it's all gone through inside that video, and I don't want to take the time in this video to walk through that. But ultimately, it then gives you 3 lines of your high assumption and your low assumption. Also gives you a table view of what that is over there. So you can see what the current earnings is, and then what the growth of those earnings is based on your extrapolation, your return, and your earnings multiple. Now, what you can see here for Meta is we are currently trading around the medium assumption over here, which is the medium growth assumption of 12% year over year. So this blue line, for example, is technically our red line, or depending on what your assumption is, the yellow, blue, and red is this red line. Now, I think Meta is significantly undervalued, as you can see from here, that it's blown through the high assumption. We're at the middle, potentially, if it goes anywhere near 110, we are in a deep recession if Meta gets to this level. And I'll continue to accumulate shares if that is the case. But I'm quite happy with this, and I've selected the 155 put strike, which I'm doing weeklies on this. I'm earning about $100 a week doing this doing this trade, and as you can see, we're at a pretty nice kind of this strike at a nice support level. It might break through, but if you look at how much it's dropped, all the ways of highs of 373, I'm quite happy acquiring 100 shares at this level with the metaverse, the Oculus, all the kind of loss-making parts of their business, which are looking to magnificent growth over the next 5 to 10 years. I feel like I'm getting that business for free with this level that we're currently at now. And we might get some negative volatility, and I'll continue to sell covered calls on this to keep getting that income coming through while I hold and then buy more shares and reducing my cost basis. So Meta is one I've talked about a lot on the channel, and again, I'm quite comfortable with this one here. Google is more an established company, and you'll see through the growth rates I put in 10, 12, and 15, as you can see over here on the right-hand side, compared to it's updated Meta as well. Yeah, so again, I've gone with a conservative assumption here, which I think on the high side, analysts are predicting 20% growth year over year. So, over the next 10 years or 5 years, sorry. So what we have here is you can see here that the current price of Google is nowhere near the high assumption value. So pre-market we're at 111 and we've got 88. So the share price still has a good 20% ish or 25, 26% more to go to get to this level. Now you can see here I've actually got the 98 put expiring end of next week, and that's because I still want to generate the premium and get the income. The plan is not to be assigned at 98. The plan is to keep rolling down if the price continues to fall. But I'm actually happy to own it at 98. It kind of goes against what I'm just saying here, but overall, I've always wanted to own Google shares, or at least 100 shares to start selling covered calls against it. So again, I'm quite happy at this level to own 100 shares, but the aim will continue to be rolling this down till we get near the high assumption. With such a big value beast as Google, I'm quite happy with the high assumption on here. There is a gap between, what's that, $38 between the high and the low. And again, it might continue to fall, but the price of where Google is compared to something like Meta, again, this is going to be $15,500 to acquire these shares, where this is 100. What's that? $10,100 to well, 9,800. I'm looking at the current price, 9,800 to accumulate these shares here. And as the price goes down, it's cheaper then to kind of keep dollar cost averaging in. So I'm not going aggressive doing 5, 6, 7, 8 puts. I am on margin, so I can do that. I'm happy to own the 100 at this level and then dollar cost average in, not at 100 share increments. It'll be at 1 or 2 share increments as the price continues to fall. So those are the reasons why I've liked Meta and Google. Two different examples. One that is significantly undervalued in my personal opinion, and another one that is not quite there yet, where I'm still utilizing options to sell put options against it. And the aim is if Google continues to go down, I will continue to dollar cost average or roll my put down until I get around the 88 and then look to accept assignment. So has it yet gone under 100? The low on this bar was 102. So it hasn't gone yet under $100. So I do think we will get some resistance at the $100 mark, being a psychological level and all that kind of good stuff. So again, if there's any tickers you want me to look at from an intrinsic value point of view, let me know. The OGT intrinsic value video is on the screen for you right now. Make sure you grab the indicator, it's absolutely free, and I shall see you guys in the next video.